Of growing up. Puzzling state of low integrity behavior standards in corporations and capital markets from capitalism and society, putting integrity into finance is purely a positive phenomenon. Michael C. Jensen, Warner Earhart. My name's Lee. Hope you're doing well. I know you're doing well. Here's a list, albeit incomplete, of common actions and activities that result in a word of executives and firms being less than whole, complete, unbroken, impaired, sound, in perfect condition. In short, these common actions and activities leave those executives and those firms out of integrity. Out of integrity behavior results in reduced workability and reduced opportunity for performance, and therefore destroys value. The remainder of this paper is focused on surveying from from the integrity perspective examples of those practices so that we begin to focus on the value that can be created by putting this system back in integrity and correcting the apparent non-value maximizing equilibrium that exists in the financial markets. Financial reporting managers regularly choose and to treat the firm's relations with the capital markets as a game where financial reporting is not driven by creating long-term value, but is little more than a strategy for managing and meeting analyst expectations, offered often referred to as guidance. Managing earnings, income, smoothing, and manipulating financial analysts does not leave the word of executives or the word of the firm whole and complete. These practices invariably leave executives and firms out of integrity with respect to word for one's word as to the existence of something or some state of the world includes being accountable that the other would find valid for themselves. The evidence that one has for asserting something to be the case, dealing with my white coat of indigenous people here in where I'm hanging out right now, Lenape, do not celebrate Thanksgiving. So, at some point in my life, possibly travel and spend a Thanksgiving with indigenous people and see what they're up to right now. Until recently, it was generally considered part of every top manager's job to manage earnings. That is, to report earnings other than as they actually are. And while somewhat less so now, this still tends to be true. When managers give their word to something other than what is actually so, in this case, their word as to the accuracy of the firm's reported financial statements, this leaves them less than whole and complete and diminishes the opportunity for performance. That is, such fudging undermines the opportunity for maximizing firm value. For too long, we in finance have implicitly condoned or even collaborated in these activities. Specifically, we're referring to managing earnings, income smoothing, etc. These issues are not merely one of deciding on strategy, they directly involve integrity and generally unappreciated negative long-run value effects of such out of integrity behavior, making organizational operating decisions other than those that maximize long-term firm value as so to manage reported earnings is a violation of word four if the markets had the evidence that we managers had when making such earning management decisions, the markets would come to a different conclusions about the meaning of those managed earnings. That incidentally, this is a reason for the various manipulations of accounting and real operating decisions that are not fully disclosed to the markets. In everyday language, violating word four is lying. When we use terms other than lying to describe a violation of word four, we inadvertently encourage the sacrifice of integrity. We have observed perfectly honest, upstanding people in their roles as board members condone manipulation of financial reports because it does not occur or show up to them as lying. It occurs to them as just part of what it means to manage. Such language effectively disables even the normal social sanctions that would limit such behavior in boardrooms and among managers as they openly discuss how to manage earnings. As we previously discussed, the cost of this out of integrity behavior will be attributed to something other than this out of integrity behavior. For example, managerial lying about earnings. As we said above, language affects the way in which what is being dealt with occurs to people. And the way what is being dealt with occurs to people affects their behavior. When executives and firms give their word to something other than what is actually so, that is managing earnings, it shifts in the way in which the firm occurs to its executives. Their focus shifts away from maximizing value to how to win the short-term gains for manipulating analysts and the expectations of the market. What's happening? My name is Lee. Hope you're having a fantastic day. Just for those joining us, investment banks defrauding clients, banks and investment banks abusing clients with misleading investment recommendations that the clients have been led to believe are intended to serve the client is not whole and complete with regard to their word. Goldman Sachs, for example, was accused of misleading its clients in the abacus mortgage-backed securities that were intentionally structured to fail, for which Goldman paid a $550 million settlement to the SEC in 2010, at the time the largest ever in history of the SEC. In addition, Goldman Sachs trader Fabrice Touré was found guilty on 6 counts of fraud for his role in the abacus debacle. See Gustin 2013 and the appendix and a continuing series of the scandals in finance below for a more detailed discussion of this fraud. Also consistent with the dynamic decline in organizational integrity at Goldman Sachs in recent years, Greg Smith resigned as executive director of the head of Goldman's United States equity derivatives business in Europe, the Middle East, and Africa on March 14, 2012, with his New York Times op-ed article entitled Why I Am Leaving Goldman Sachs. Quoting Smith, 2012, after almost 12 years at Goldman Sachs, I believe I have worked here long enough to understand the trajectory of its culture, its people, its identity. One sec. I can honestly say that the environment now is as toxic and destructive as I have ever seen it. To put the problem in its simplest terms, the interest of the client continues to be sidelined in the way the firm operates and thinks about making money. Culture always a vital part of Goldman Sachs' success. It revolved around teamwork, integrity, a spirit of humility, and always doing right by our clients. The culture was a secret sauce that made this place great and allowed us to earn our clients' trust over 143 years. It wasn't just about making money. This alone will not sustain a firm for so long. Today, if you make enough money for the firm and not currently an ex-murderer, you will be promoted into a position of influence. What are 3 quick ways to become a leader at Goldman? A, execute on the firm's axis, which is Goldman's peak of persuading your clients to invest in the stocks or other products that we are trying to get rid of because they are not seen as having a lot of potential profit. B, hunt elephants. In English, get your clients, some of whom are sophisticated and some of whom aren't, to trade whatever will bring the biggest profit to Goldman. Call me old fashioned, but I don't like selling my clients a product that is wrong for them. I attend derivatives sales meetings where not one single minute is spent asking questions about how we can help clients. It's purely about how we can make the most possible money off of them. It makes me ill how callously people talk about ripping their clients off. Over the last 12 months, I have seen 5 different managing directors refer to their own clients as Muppets, sometimes over internal email. No humility. I mean, come on, integrity is eroding. I don't know if any illegal behavior, but will people push the envelope and pitch lucrative and complicated products to a client, even if they aren't the simplest investments or ones most directly aligned with the client's goals? Absolutely. Every day, in fact. It astounds me how little senior management gets a basic truth. If clients don't trust you, they will eventually stop doing business with you. It doesn't matter how smart you are, people who care about money will not sustain the firm or the trust of its clients for very much longer. Based on evidence on the Goldman culture summarized by Smith, the conversation, one sec. Conversation with Goldman Sachs about its relation to clients, or stated as a matter of integrity, the firm's word to itself about its relation to clients is obviously in inimical to its interests of its clients. What is clearly invisible to Goldman Sachs's management is that such behavior, and like this is written in, I don't know, 2014. I mean, it must be after 2012 because that's what he's talking about. Maybe Goldman's completely, revamped everything. I don't know. Goldman's out of integrity behavior is advanced, evidenced, and I would stand for them to have done this years and years and years ago. I'm sure they had to have read this paper. Was Goldman Sachs even still in business? No, that was Bear Stearns. In conflict between the firm's word to itself about its relation to clients and its word to its clients, and as Smith says about the resulting damage to the firm, such behavior, if clients don't trust you, they will eventually stop doing business with you. On its website, Goldman Sachs represents itself and gives its word to the world, including its clients, in the statement of its business principles and standards, Goldman Sachs business principles. The first and last Goldman's 13 principles states, our client's interest always comes first. Our experience shows that if we serve our clients well, our own success will follow. Integrity and honesty at the heart of our business. Given what Smith reveals about the conversation with Goldman Sachs about the firm's relation to its clients, the firm's word to itself, Goldman Sachs's word to its clients is clearly not whole or was not whole and was not incomplete and was broken. The very definition of out of integrity, the obvious cost of Goldman Sachs and other firms of not seeing the impact of its out of integrity behavior is cost of lawsuits, penalties, and settlements, but the non-obvious costs of such behavior is the impact on clients' behavior and the extent of the reduced reputation and moral or morale of the firm, all of which are much less obvious and sometimes dismissed as just the cost of doing business. Such out of integrity behavior in the financial world is not limited to Goldman Sachs. Smith is dumbfounded at Goldman not seeing the self-inflicted damage from its out of integrity behavior. How little senior management got a basic truth. If clients don't trust you, they will eventually stop doing business with you. Emphasis added. The source of what dumbfounds Smith and what hides the damage from out of integrity behavior is discussed above in section 3, the veil of indivisibility. It's in another video. Check it out. In that section, we argue that mastering the 11 factors that constitute the veil of invisibility creates actionable access to eliminating the damage done by out of integrity behavior, or at least unconceals the behaviors that are generating the damage. Interestingly, both Smith 2012 book, Why I Left Goldman Sachs, A Wall Street Story, I mean, they had to have read this book, and his resignation letter have been criticized by figures in the financial press and members of financial community. What are you doing? For example, C. Blankfin and Cohen 2012, Stewart 2012, Roos 2012, Slotzer 2012, and Rule. We conjecture that many in the Wall Street community considered that Smith's book's accusations unimportant because they expected and did not find documentation of rampant, outright illegal behavior in the book. The book contains considerable discussion of out of integrity behavior and the damage it is likely to cause, although Smith does not provide the specific integrity language. This failure of the financial community to recognize the lack of integrity at Goldman, described by Smith, and the financial community's failure to see its importance, says something noteworthy about the culture of Wall Street community and the press that covers it. I'm so excited. You're talking about the media and what is this, 2013? Smith's book clearly indicates a serious lack of integrity in the culture at Goldman, and the book is inconsistent with out of integrity actions that, and let's bring all of this conversation to crypto, that Goldman has taken such deals as the Abacus 2007 ACI mortgage-backed securities issue, in which Goldman intentionally structured that issue to fail and misrepresented those securities as its purchasers. Goldman's clients lost over $1 billion within months of their purchase of Abacus, and Goldman's paid a fine of $550 million to the SEC. For more detailed discussion of Goldman's integrity and lack thereof, see Appendix 1A below. I would love to see the financial statements from this deal. See also the appendix starting on slide 32 in Jensen and Era 2011. This is written in 2011 and then redone in 2013. For more detailed discussion of Goldman's violation of 7 of Goldman Sachs's 13 business principles stated on its website, Michael Lewis 2013 had the following to say about Smith's Goldman events. This is Michael Lewis of Moneyball and Big Short? Question mark. Either way, you had to admire Greg Smith's nerve. Still, his piece raised a couple of questions that I hoped his book might answer. The first is, why now? Goldman was helping the Greek government deceive the European Union about its indebtedness back in 2001. Remember when Greece went bankrupt? By 2004, the firm was busy manipulating the ratings agencies and public investing public to help expand the market for subprime mortgage bonds. By 2006, it was designing securities to fail. The infamous Abacus program so that its own traders could bet against them and make profits at the expense of their own customers by, in effect, pumping vast amounts of trust reducing pollution into the financial system for a very long time. Now, the firm has been famous for being more frightening than helpful to its customers. Smith first worked for Goldman as an intern in the summer of 2000 near the peak of the internet bubble that was inflated with the help of Goldman's analysts. Consistent with Smith's judgments regarding Goldman Sachs' out of integrity, the behavior, Bodnaruk et al. 2007, their empirical study of the dark role of investment banks in the market of corporate control find that out of integrity behavior, our words, not theirs, goes far beyond Goldman Sachs. As they conclude, page 1, we argue that advisors are privy to information about the deal that they directly exploit in the market by investing in the target. We show that the bank's advisors to the bidders tend to have positions in the target before the deal. The existence of a direct state of the advisor to the bidder increases to the bidder increases, not bitter. The bidder increases the probability of the bid and the target premium. Advisory banks profit from such a position. A trading strategy that conditions on the stake of the advisors delivers a net of risk performance of 4.08% per month. This cannot be replicated with available information. We also show that advisors not only take positions in the deals they advise on, but also directly affect the outcome of the deal and its probability of success. This has a negative implications for the viability of the new entity. All right, we'll continue with money managers defrauding clients. I hope you're having the best day ever. And let me know what you want to hear more about. And yeah, buddy. Later.